Hi, everyone, and thanks for being here today. I wish I could be here in person. I certainly had planned to. Everything was booked, flights, hotel, and everything. But today's world being what it is, I ended up a couple of days ago catching COVID, and I don't think anyone would enjoy catching it from me. And I'm not in any condition right now to be traveling anyways. So thankfully for today's modern technology, we can still do this in some form, and I can still have the pleasure of bringing my presentation to you. So let's get right to it. Today, I'm going to talk about what I see as a huge opportunity that is shaping up in silver juniors. Let's first talk a little bit about the silver price. So certainly sentiment has been weak for the last several months, especially once silver went below, say, $20 or so, and has been averaging around $18-19. But if you look over the last 6 years, in fact, for the first portion of that, from late 2016 to late 2019, silver actually averaged about $16. And then if you look at the last 3 years, so before COVID hit, and then after that and onward until today, in that last 3-year period, silver has actually averaged closer to $22.50. So that's a 40% gain, despite recent lower prices. On average, as I say, the last 3 years are about $22.50 silver price. That's about a 40% gain for silver. So overall, silver actually has done relatively well and moved into a higher average price level. But of course, silver has some of its challenges. Sentiment-wise, of course, that's one thing, but some of the things I think that the market's looking at are concerns about recession. At this point, I think that's very much or pretty much a done deal in terms of that being likely to play out. And if there's recession, I think the market's looking ahead at the risk of a slowdown, which would affect on the industrial side, that would affect industrial demand potentially for silver. But there is a bit of a silver lining to that, and the fact is that a slowdown in the economy could easily affect base metals as well. And so a large portion, about 70% or so of silver, actually comes from the production of other metals, things like copper, lead, and zinc. And if there's a slowdown in demand for industrial metals, that will automatically mean, if there's a scaling back of production, that will inevitably mean a scaling back in production of silver, which comes from mining these other metals all at the same time. So that would actually help the supply on the supply side, help somewhat on the supply side by lessening supply when there's a concern for slower demand. Silver competes with a strong dollar. The strong dollar right now has been what we've been experiencing for about the last 6 months or so. The US dollar index has been running up from about 100 to 113, 114. It's backed off right now to around 110. But it remains strong versus other currencies, and the strong dollar certainly weighs on commodities, silver, of course, included, because silver is priced in dollars. Thirdly, silver competes with strong bond yields. So bonds in the last, say, 9 to 10 months or so have really taken a hit, but that means that their yields have pushed up. So much stronger bond yields means, of course, silver investors are not investing in a vacuum, and they look at other assets that they could invest in. And of course, nominal yields are still below zero, but if you're looking at real yields are still below zero, but if you're looking at real nominal yields, 4% is attractive to many investors, especially on a short-term basis. And so I think that that's attracting them and competing with silver. So here's another way to look at things, and there's some interesting research that was put out recently by Oxford Economics and the Silver Institute, and they looked at how much silver would make sense in a portfolio. So what they did was their approach was to take a diversified portfolio. They included stocks and bonds from developed and from emerging markets. And they also included gold and commodities. And they did this in two phases. First, they looked at the historical side of it, so over the last 23 years. And then they looked ahead at the next 10 years. And here is what they found. So in the last 23 years, in order to do this exercise, what they did was they ran a number of simulations. They varied the allocations to the different asset classes, which included silver. And silver obviously was moved around to different percentages to compare a low risk, medium risk, and high risk scenario. And in each case, it certainly was not only did including some silver lower risk, but it also helped increase returns. So in the low risk portfolio simulation, the ideal amount of silver was 4.4%. In the medium risk portfolio, it was 4.9. In the high risk portfolio, it was 4.7. So clearly, silver in the last 23 years helped the average portfolio lessen risk and increase returns. But then Oxford, in its research, decided to look at the next 10 years. They used their own global economic model to look ahead, and they considered some of the activity in stocks and bonds in particular over the last, say, 9 months or so. And they also looked at silver in particular relative to gold, and determined that silver relative to gold certainly has less downside risk because it hasn't risen as much yet. And if you look at the gold-silver ratio, which they ran here, the long-term average over the last 40 years or so is about 65. Today, we're still at about 85. So silver remains cheap relative to gold. And so that helped determine the forward outlook for what kind of silver allocation would make sense. So here are the results. Again, they they ran their simulations. They varied the allocations to different asset classes. And looking forward in the over the next 10 years, the low risk portfolio would carry 5.6% silver, a medium risk portfolio 6%, and a high risk portfolio 5.8%. So according to Oxford, over the next 10 years, they expect that a slightly higher allocation to silver would even make more sense in terms of lessening risk and increasing returns for the average portfolio. So here are some of the takeaways. Clearly, silver is different enough in terms of how it behaves to add value as a portfolio diversifier. Another point that Oxford brings out is that the average portfolio has just currently 0.2% allocation to silver. And even that is indirect exposure to silver through a basket of commodities. So if you look forward, where they determine that the optimal amount would be 6% over the next 10 years, to go from the current 0.2 to 6% would mean multiplying current exposure in the average portfolio by 30 times. So that's certainly a big number. But even if you aimed for a 2% exposure to silver in the average portfolio, that would still require the average investor increasing their exposure by 10 times the current levels. So remember, the silver market is very small, and so a significant buying really would have notable impact on the silver price. Here I look at the supply balance shortfall. It's still very negative. This is a forecast by Incrementum over the next 4 years, including this year. They see supply continuing to fall, and yet the balance continuing to rise. So clearly, as far as they're concerned, there's a shortfall, and it's an increasing shortfall in the supply balance for silver. Here's an interesting chart from Capital Light Research. They looked at mine startups in the silver space. And globally, they saw that when the silver price rose in the first half of the 2000s, from 2000 to about 2011, as the silver price rose, mine startups increased on average. And then as the silver price declined, you could see these bars, the blue bars, started to decline as well. Silver moved sideways for a few years until about 2018 and started to climb again. And yet, globally, silver mine startups have continued to fall. And so we've got this increasing gap between the silver price and between new silver mines. So that goes to show you that despite a higher silver price, the reaction from silver miners hasn't been there to bring new mines to market. And so that should also be supportive of the silver price. If we look at the largest producers globally, those include Mexico and Peru. And by far, in fact, some of the largest producers, national producers of silver. And both of them peaked actually in 2016. They've been overall on average declining their annual output of silver. And so even the largest producer, so that's certainly a concern in terms of supply, but we see the largest producers of silver are not increasing their production. In fact, it's dropping off. So very interesting point. So what about silver miners and explorers? What is the outlook for that? Well, if we look specifically at gold miners versus the S&P, this chart shows on a relative basis how gold miners behaved relative to the S&P. This is the ratio. It hit a low of 1.2 and a high of 15. That's from about 1999 till about 2010. And so gold miners actually expanded by a multiple of 12 times versus the S&P in that period. Of course, at that point, they peaked, dropped off, and then have moved sideways since. Especially the ratio obviously stayed low because the S&P climbed dramatically, especially since 2009. I think we're moving into a new period. The S&P has rolled over, bonds have rolled over, and I think we're going to move within the next year or so into a much, much stronger period for gold miners. And then we're going to start to see this multiple expansion once again, probably in my view anyways, outpacing what it did in the first part of the 2000s. This chart shows gold miners versus gold in this case. And so the gold miners versus gold, that's the ratio here. When we started that huge bull market in 1999, 2000, the ratio hit a low, and that was about 0.7. And then it ran up, of course, corrected, and then we hit a low in about 2014 or so of 0.33, and we're still today at only 0.41. So gold miners versus gold are extremely cheap. In fact, interestingly enough, they're cheaper even almost by half of the levels that they were when they began their first bull run, or their last bull run, I should say, around 1999, 2000. So all that to say, gold miners versus gold are extremely cheap still today. This chart shows a ratio of silver miners to gold miners, the SIL to GDX ratio. And what we see is since about July of this year, silver miners have actually started on average to outpace gold miners. So it's interesting to see that there's more interest coming into the silver space versus the gold space over the last, say, 4, 5, 6 months or so. Now some interesting indicators. The precious metals miners have shown a tremendously positive cash flow. This chart shows the universe of the S&P. It includes all sectors except financials. And if you account for inflation, other than financials, the gold and silver miners are the only sector that have had a positive year-over-year change. It's really quite impressive to see just how much they've been profitable. And this shows and quite clearly how that has changed in the last few years. So since about 2019, profitability has absolutely soared for precious metals miners. They yielding on average about 7%. It's a tremendous free cash flow estimate. As I say, they've been churning out plenty of profits. So, and this shows the percentage. So 70% of miners are actually positive free cash flow, 73% to be specific, in 2021. So, and that's growing. So really, again, a sector that's doing very well, quite healthy, despite in some cases stock prices, because this does not, of course, take into account stock prices. It's simply free cash flow profitability. So that leads me to where I see the opportunity in silver juniors. Specifically, silver miners, this is their Capex cycle. And that peaked in about 2013, fell off dramatically, moved sideways, and in the last couple of years has trended downwards. We've seen in the last couple of years down about 18% year over year. So they've been making money. They have not been spending it on their production, on replacement, and so they've just been building up that cash. Precious metals miners have a lot of room to catch up overall in the Capex cycle. So this yellow line shows the price of gold from about 2000 to 2011, when it rose very steadily and then pretty strongly in that last part. The blue bars show how Capex very much followed the gold price through that period. There was, of course, a bit of a lag, but it was clearly following the price of gold. Again, Capex peaked when the price of gold peaked, continued to fall off, in fact, fell off and then moved sideways and weakened even more than the gold price did. Gold price moved sideways on average from about 2013 or so to 2018, 2019, but the Capex continued to fall. And about 2018, 2019, the gold price rose again. And Capex basically has maintained a huge gap between its levels and the gold price. And so we can certainly see here again a lot of room to be made up in terms of capital spending by gold and silver miners. This chart shows gold and how gold miners have spent a lot of money. They have big budgets, and yet they have no discoveries to show for it. This black line shows the amount being spent on exploration to find new deposits. The current level is about $6 billion a year. It's been rising, in fact, over the last 3 or 4 years. And yet these bars down here, these yellow and blue bars, are projected new gold discoveries and gold reserves. And so that has not only dramatically fallen off, but has very much moved sideways. It's almost zero, despite increasing amounts being spent to find new gold deposits and silver deposits. The results are certainly not there to show for it. So I think this has created a huge opportunity on the M&A side. There's a huge gap, very much like the Capex cycle. And so this yellow line again is the gold price from about 2004 to 2012. And the amounts of M&A actually took off in the latter years of that last bull cycle. Fell off dramatically as the gold price fell off. That basically was almost flat for pretty much 8 or 10 years or so. The gold price started to move up in 2018, and we've seen M&A continue to move sideways. There's an even bigger gap in this case in the M&A cycle versus the gold price. And again, a huge opportunity, I think. What's likely to happen is we're going to see the precious metals miners that are going to see things turn around once the Fed pivots and their share prices start to take off. They're likely to start using their shares as a currency to get active on the M&A side. Certainly, they haven't been, as I showed you before, making the discoveries. They're going to turn to the juniors, where they've been delegating the responsibility of trying to find new deposits and of developing new deposits. And they're simply going to use their shares to buy out these companies. And we're going to likely see a big wave of M&A activity. So I think that creates a very big opportunity on the junior side, junior silver explorer side. So these are all topics that I talk about in my recently published book, The Great Silver Bull, which is available on Amazon in paperback and in Kindle. And that pretty much wraps it up for me. If you'd like to follow my work, you can go to silverstockinvestor.com. I'm on LinkedIn and on Twitter. And that's it in my case. So thanks very much for watching. Right now, I'd like to hand it over to Gwen Preston, who is going to do for me the introduction to our next presenters, a couple of junior silver companies that I think you're going to find especially attractive to hear their stories. Thanks very much.